Okay, welcome back, everyone. We're going to move on to another adjacent topic, and we're going to talk about what we call squats and reversal recoveries. And I'm also going to give you another little technical pattern. I'm not going to tell you the name of it right now, but I'll show you a little later on. It's sort of a new, well, not new for me. I've been using it for a while, but I never talked about it much except with some of our members have heard it before. So we'll get to that in just a second. So we talked about stocks breaking out and watching them immediately after the breakout for violations and confirmations and so forth. There's a particular characteristic or pattern that happens sometimes when you break out and you squat. All right. Squat is just simply a term for a reversal that comes back in and just sits back maybe in 50% or less of its range. If it closes up in the, top third of the range or up by the highs, that wouldn't be a squat, of course. But if it comes back in and closes generally, 50% of the range or less, that would be thought of as a reversal and a squat if it was on a breakout. I call it a squat when you try to break out. You can see right here how the stock tries to come out and then it pulls back. Now, a couple little things that once that happens, I almost never sell the stock just because it's squatted, particularly if I'm swing trading. If I was very short-term trading, maybe if my stop was super tight. But for swing trading, I would already probably have a stop in, below the low of the pivot, or maybe a 5 or 6 or 8% stop. So that probably wouldn't trigger the stop. So now what I do is I watch it very carefully, though. The next day, I'd like it to close. I mean, I really would like it to hold the low, but 50-60% of the time they take out the low. But then if it does take out the low, if it's just undercuts it slightly and it can rally back and close within the range, inside the squat day range, then I'm still okay with it. It's not a problem. There's no violation there. And then what I looked at, what I want to see happen is I want to see that squat high, which is the reversal, get recovered and get through that, which I call a reversal recovery. And generally, this should happen within a couple days to no more than a couple weeks. Usually, they happen within days. If it's going to work out, it'll happen in a few days to maybe a week. Sometimes it's more than a week. If it's more than 2 weeks, it's really too long. It's abnormal. So again, if we go inside and the range is inside, that's the best sign. And when you take out the low, it does lower the probability of success. And if you close below the low of the squat day, it lowers the probability of success a little bit more, but not enough, like I said, where I would sell the stock there. I would still wait to see if we can get that reversal recovery. And very often what will happen is it'll rip through that reversal and come breaking out, and then you'll get that breakout. But it just comes a couple days later. Even sometimes you get low volume breakouts that they don't squat and they're on low volume, but then the volume starts coming in subsequent days, and you might get 3 days up, but the volume doesn't actually come in until the third day. Dave, we talked about having the volume on the breakout and having multiple days of breakout. Some people take this stuff so literally that, if they don't see exactly that perfectly, or if the stock breaks out on low volume, they immediately sell the stock and take a loss or maybe break even on it. But we to be that critical, are you selling the stock, or if it doesn't break out on volume, or are you giving it an extra day and see if the volume comes in?
No, if the technical setup, if the price action is fine, then then if it doesn't get a 200% increase in volume, then I'll be okay. I'll give it time to see if that volume comes in. But sometimes you just don't attract as many institutions as you would like. And so sometimes you do get lower volume breakouts, and then the volume comes in later on. But if the stock has a nice, move, and it's not on a huge increase, give it some time to see if it continues on.
Right. Yeah.
So it's
Yeah.
it's not it's not abs. I wouldn't sell it just because it didn't get that huge increase in volume.
Right. And so you should have already come into the trade knowing the amount of risk that you're going to take and having that stop laid out. So what I will do is I'll stick with that stop. And unless I see a violation, or usually multiple violations starting to pile up that are happen above that stop, I'm probably not reducing. Now, there's a few caveats. Let's just say this breakout was up 10 or 15% on the day. So it's way up here. Maybe it looks like this bar, this breakout bar. So imagine this bar now reverses, squats, and comes all the way down and is maybe trading, way down by the lows. Now, in that case, I'll usually reduce or maybe even sell because it's just such a giant amount of price to make up. That's rare. That's rare, but it does happen where you get a big day and then you get a big reversal. And even then, I'll probably keep a piece of it and still stick with my stop because it could recover even that high, that reversal high, sometimes in just a couple of days or a couple of weeks before it actually stops you out. Let me show you a few more examples, and then we're gonna talk about some of the caveats and how this can manifest itself. It's subtle. This is subtle stuff, but you're gonna see how this all works together as you start from the left side of the chart, and you work your way up with the long-term trend, making sure that you're in a long-term trend and looking for the chart patterns and looking for the VCP and then the entry point. Now the stock's going to break out, and you're going to start looking at these subtleties to see if indeed how strong the breakout is, and the fact that you can recover that reversal relatively quickly is a good sign. It's a very good sign. So a squat's not a violation. It's just sort of an orange flag, or even maybe a red flag, but definitely an orange flag. So in here you can see, and again it's subtle, but you can see you come out here, you break out, and then you come in there, and actually this was on a little bit of a gap. You actually gapped out a bit, and then you close almost down by the lows. The next day you trade, but you close inside the range, and then you see you have your second day of trading subsequent to the squat. You move into high ground. Now you have 1, 2, 3, 4, 5 days up. See, the stock's acting pretty good there, and you can see the volume is not really that big. And again, if you get big volume on the breakout and it squats, that's some churning, that's some distribution, but it's short term. It's one day, so you want to give it that extra bit of time. Show you another example here. So these can set up. This one set up, which looks sort of like a cap, where you form this little pattern, right? So you come out here on what we call a pause pivot. It was just one day, or actually it's 2 days. I'm sorry, so small here. You got 2 days. You form this VCP. It tightens up, breaks out. Now here's a perfect example of where it squats all the way back. It closes on the dead low. Now next day follows through to the downside. Again, this may not be big enough for me to sell it all. I probably just reduce because this isn't a huge bar. Dave, if you had a real big breakout, let's just say, this is up 10, 12, 15%, then it comes all the way back and closes at the low. That's a bit more ominous, right?
Yeah, I would definitely take some off. I might even on this day. Well, I would probably be reducing the position on the second day after it squatted and then went lower.
Yeah.
That's not a good sign because now it's down to the back, very close to the bottom of the base, and you don't want it to go through that 13 level. So what sometimes I do is I sell just half the position or part of the position and see if it can make it. And in this case, it looks, it went inside and then started turning up and started doing much better. So there's nothing wrong with buying it and actually reducing it on the first or the second day, especially if it's not acting the way you thought it should be.
Yeah, and so now one way to play a reduction is that, okay, you reduce it, and then now if your stop is hit, you've actually truncated your loss, if you will. Your loss is going to be a little bit smaller because you took a little bit off before the stop got hit. So now let's say your stop doesn't get hit, and you you take half off, and now it's resets here, and then has the reversal recovery. A lot of times, what I'll do is I'll add back now. So I'll that's what we call a reduce and add. So you reduce it, and then you add it back as the stock resets. But the stock would have to reset, not just just because it goes higher. The stock would have to reset, and it'd have to come out of a base or a setup that would be something that I would buy anyway. And certainly this is getting even better. You see it tighten up nice here with the pivot. And now it comes out and it takes out that high, and you get that reverse recovery. And it's an eight. Was it an 8 day? 1, 2, 3, 4, 5, 6, 7. Yeah, 8 day reversal recovery. And then you see how efficient. Wham! Takes right off. Now you've got that last little bit of supply. See, this just shows you that there was a tiny bit of water left in that towel. And once they wrung that towel out to the final last drop, now the stock can go. Simple laws of supply and demand. Now over here's another example where you see it tries to come out. It comes in a bit. It's about in the mid of its range. The next day takes out the low, but this really, it's not really doing anything that bad. And a lot of times it'll come in for just one day, it'll go inside, and a few days later, boom, you're right back into new high ground. So if it didn't take out the low in the pivot and it hasn't hit your stop, you really want to just stick with it and just wait and give it that time. Give it the time to prove you right or wrong. Trading speculation is about anticipating coming movements and then waiting to be proven right or wrong. The part that a lot of people can't do is they don't wait. And that on the downside and the upside, they go in there and they have a plan and they have a stop, and then they sell it before the stop ever gets hit, and then the thing takes off and they, oh my God, I shouldn't have sold it. Or they don't sell it, and it goes through their stop and they hold it and it gets a loss. So having this plan and waiting to be proven right or wrong is really important. That's why you want to go in with a plan and execute that plan, then go back and look at it later and see, was that a good plan or not? But if you don't have a plan, if you don't stick to a plan, you have no reference point, and you're not giving the stock a chance. You got to give these stocks a chance. Stocks fluctuate, and while you may get them perfect at times, most of the time you're not going to get them perfect. Dave, how many times do you get a stock absolutely dead perfect? Percentage of the time where you buy it, it takes off, it's up 4 days in a row, and never puts any pressure on you, turns into a winner.
Yeah, that's rare where it actually acts perfectly and it never scares you. In a lot of cases, you're going to be, they're not going to act exactly that way. They're going to scare you. They're going to try to get you out. And so that's why you have to stick to rules, and it takes away that emotion. And eventually you're going to get a number of great winners if you follow all these directives.
Show you another example here. Now, this same concept is valid whether you're coming off of the low cheat, the handle. This is valid anywhere coming out of the base. So you can see here, you're coming off this little low cheat area, right? You had a recent, as a matter of fact, you even broke out over here. You see you squat it, and then 1, 2, 3, 4, 5 days later, 6th day, boom, you're into new high ground, and you stayed inside all those days. You stayed inside. That's a good sign. That's exactly what you want to see. Staying inside like that is the best case scenario, as opposed to the best case scenario, it comes ripping back the very next day. But other than that, if you're going to pause for a while, you want to be inside. So here we try to break out, we come all the way back down, close maybe in down to 20% of the range. Next day you get a gap up and then right back, and then it's 1, 2, 3, 4, 5 days up. And now you get the breakout. See, so if you got shaken out there on that small little pullback in the first day of breakout, you would have missed this nice move coming out. And again, take a look here: 55% in 15 days. People think that we show all these big winners, but a gain that's even 55% isn't exactly a small gain, but certainly in 15 days it's not a small gain, and that's a tremendous gain in 15 days. So these gains can add up. You can have 20% movers, and you compound those, it really turns into something pretty quickly. So we're going to show you what we call super performers. Even if it goes up, again, 40, 50, 60% in just a couple of weeks, in our book, that's a super performer.
And now,
not just, yeah, go ahead,
yeah,
Dave.
Mark, I was going to ask, and just from your experience, do you see that when you are buying off of load sheets that you get more squats just because there is probably more overhead because you're at a lower buy point? Do you find that there are more squats on the lower entries or when they're actually breaking out to new highs?
We found that it's a function of the market. You could, yes, you could get, if the market's not strong because you're going into supply, you will get more. But sometimes you come ripping, the market is just, you're in a rip roaring market and things come out really nicely. So to be honest, there's not really, you can't really say that there's going to be more just simply because you're coming off the cheat. It makes sense, though. It makes logical sense that you're going into supply. So you're going to have, but it doesn't necessarily have to manifest itself as a squat. You might even break out and be up that day at the high, and then the next day you come back in. That's not technically a squat. This is what we're talking about, is day one breaks out and then closes down in the range. So there's a lot of ways it can manifest itself. But I would say what Dave is saying is absolutely correct. You're probably going to, well, let's just put it this way. The lower you go in the base, when you go to the low cheat, it's going to be a lot trickier than in the cheat. And when you're in the cheat, it's going to be trickier than in the handle because, again, the lower you go in the base, the more that you have overhead supply. When you're going into new high ground, you have no overhead supply. So you've eliminated that. So again, it does make sense, but we don't really have the evidence that there's going to be more squats on the first day coming from those. But it might be good to analyze and see if there is a correlation there. So L3 communications is one that, and this is one that you can very easily make a case for selling, because you come out here and then you engulf the previous day. So you get a bearish engulfing, but you see it stays inside. And then a couple of days later, you're back in new high ground. So sometimes, as Dave just said, he said it can scare, it'll scare you. A lot of times there's these still scary looking, bars, but they're just 1 or 2 days. You've got to have the rules, and you got to be able to look at the charts and really understand what's going on here, because it may not be nearly as ominous as you think. And when you look at this, you say, oh yeah, no big deal. But you're in a position here and you take a big position, whatever the number might be, whether it's $1,000, 5,000, 50,000, if it's a big enough number, and as far as the dollar loss, you'll rationalize yourself. Say, oh, this is an outside day that's closed on the low or near the low, and you'll sell it out just simply because. And that usually means that you're positioned too big, because if you start trading emotionally based on the position size, you're trading too large. You're not able to stick to the rules. So you really have to position size yourself. This is probably a good time, Dave, to just ask you, as far as, I know you can relate to it, but how do we combat that, getting into a situation where you get into the stock and it's all rosy and you take this position, but a lot of people, they don't think about, if this thing moves against me and it's down, it takes out yesterday's low, I'm going to be down $5,000, and they don't really realize that they can't really emotionally handle a $5,000 loss. So then they get to that point and they sell it, and it hasn't even hit their stop yet.
Yeah, well, that sounds like it's just that they're not sticking to their discipline in terms of the size of the position. You should always start out with the exact same size position, and then also exactly how much you're going to add to that position as it starts working out. But yeah, no one ever asked me, well, you won the U.S. Investing Championships 3 years in a row, and no one ever asked me, well, did you enter again? And I said, yes, I actually entered again a few more times. The next year, the fourth year, I put so much pressure on winning again that I took too big. My position size was too big, and I was breaking the rules, and I was looking more at the results than actually doing the right thing in terms of buying the stock and adding to it correctly. And so I was actually flat the next year. But then I think the following year after that, I came in second. So if you start breaking rules and your position size goes up, or you're chasing stocks, then bad things can happen.
So two things. I just learned something about David Ryan. I did not know that, Dave. I
Yeah.
did not know that you were. I didn't know you entered subsequent years.
Yeah.
So that's actually news to me. Pretty neat. So you basically you got out of process, and that next year, that fourth year, you start looking at the results, and you
Yeah.
just got out of the process. See, I don't even look at results. I don't even look at the. Sometimes I literally go. We talked about this before, but I'll go days without knowing what my account balance is, as long as things are working, and I'm, like I said before, like running racks, or actually maybe I said this in an MPA session. I can't remember if I said it during this, or I might have said it in an MPA session with Mark Ritchie, but where it's like a pool player, running the table, or a golfer that gets into a groove. When I'm in that groove, I'm just kicking butt and taking names, as they say, and just moving forward. And I try to stay in process. When you start looking, one of the best things I did many, many years ago is I used to keep, and some of you probably have this to this day, where you keep that little box on your screen, and it shows your total gain or loss for the day. So if you have 10 stocks, it's going to calculate and say, you're up or down, let's say $3,000, and that thing just ticks away. And boy, that is the most emotionally pressing little indicator or a little light that you could ever have on your screen. That when things start turning against you and you see it goes 6,000, 7,000, 10,000. Oh, it's horrible. It's horrible. You got to get that off your screen. Oh my God, that thing will wreck you. Well, I took that off my screen, and my decisions improved so much, and I calmed way down. So stay in process. But yeah, I did not know that about you, Dave. That's
Yeah.
something.
The other thing too, going back to the old days when you used to only get, nothing was online. You would get your brokerage statement at the end of the month, or
Right.
you could call in and ask. But yeah, there would be times where I would go the entire month, and I would just ask for my buying power. How much could I buy? And
Right.
I wouldn't even ask about the equity, because I didn't want to know. I just wanted to, again, as you said, stay in the process, just keep on following rules and not get so caught up in that. And it's, these days you can, as you said, you can see it all the time. But that's just not so healthy.
I actually used to buy. I wouldn't even know my buying power. I would buy and buy as much as I could until I got a call from the brokerage firm. I got a Fed call, and they say, "What are you doing? What do you mean?" Back then, it was very different than now. The computers didn't track things. You could literally
Right.
buy and buy and buy way above what your buying power was. So let's just say $100,000 account, 2-to-1 margins, 200 grand. I'd buy sometimes $400,000 worth of stock, and then they'd call up and say, "What are you doing?" "What do you mean? I'm trading." "Yeah, but you're way above what your limit." "Oh, I'm sorry." And then I'd sell it off. And I knew I was way above. I just keep buying and buying and say, "I'm going to use their money today until they give me a
Good.
call and tell me to stop." Anyway, let's see here. It's totally different now. Everything's tracked to the millisecond.
Right.
So this is a stock that I actually bought coming right out here. You see, it's a little low cheat area within this power play. And you can see it came out, and it wasn't a big squat. It was right in the middle of the range, but it went inside 1, 2, 3, 4 days. Fifth day, you get a reversal recovery, and it goes inside for a day, and now you're off to the races. So again, it took a little bit of time that you could have definitely added to this, because this actually, you see, again, everything we're showing you works on all time frames, right? We've just compressed this down. We got a low cheat, right? Now we've got a cheat. And you could even call this a handle. Let's just say these were weekly bars. This would be perfect for having your low cheat, your cheat, and your handle. You have the same thing, just over just short number of days. So these are all buy points. You can be buying a little bit here, and then add to it here, and then add to it, finally coming into new high ground. And now the stock takes off, and this goes up a nice little move in 15 days. I can't remember exactly where I sold this one, but I did buy it right here. So LinkedIn, I did buy LinkedIn coming. This was after it had gone public, And we actually showed this in the IPO, in the primary base section, where it went public, and then it had a big decline, and then for a number of years, and then finally it set up on the right side, and this is what it looked like zooming up on it. Yeah, I wanted to buy it. I was looking to buy it coming right out here, but it came on a gap, so I stayed away from it. But then it tightened up a bit more. It started to come out, but then it stalled. It didn't come out on that day. Next day, try to come out again, stall a little bit again. It just sort of like stalled its way and wedged up, and then finally it started coming out here. But see, it's a quiet breakout. It wasn't a real quick, fast breakout, but never hit the stop and never put any pressure, never even took out the low of the squat. So that's fine. Amazon came out right through here. And I bought this coming out, and you can see it had a squat, it had a little outside negative engulfing, bearish engulfing, and then the next day, boom, right back, and then you had another reversal, and then the next day it recovered that, and it was off to the races. There's another one. So here again, we break out. See, look at the pattern. See how there's always VCP. Are you guys watching this and seeing how in everything I show you, there's always VCP? Look here, you come down, you actually have a low cheat right here, right? Then you form right here, you have another here and a tightening where you get now just one last day. See that last day? That's your last tightening. And then bang, you come out here, you squat, and then a couple days inside, recovery on a third day. This went up 80% in just 13 days. See the volume here? Look at the volume characteristics. Look how low the volume is. And then on the breakout and the low cheat, you get a spike. Then the volume comes down again. And then you get a break on the breakout. You get some volume. And then as you recover here, you get some volume. Perfect volume dynamics, perfect tightening, and everything's just set up absolutely perfect. And if you take a look, it's a big cup with handle. It's just a big giant cup with handle pattern. This actually looks similar to Gilead. Gilead looked very similar to this. I actually thought when I saw this first and didn't look at the symbol, I thought this was Gilead. But anyway, this is just another one where that right side, you might see that tightening and get what we call fractals, these patterns within patterns on the right side. But this whole entire base is one big VCP. So I promised I was going to show you a little something that I don't talk about too often. Some of you might have heard me talk about this before, what we call the Hardaway crossover. This is a pretty rare, this doesn't happen too often, and it's hard to take advantage of, but it is something that I've observed a number of years ago and been trying to perfect using it or avoiding having missing a decent stock that gets me knocked out because of this phenomenon, if you will. So the Hardaway crossover is named after a basketball player, which some of you are into sports, you would know immediately, Tim Hardaway, who used to had a mean crossover. You know, he'd go left and then turn right and go right and just blow right by you. It was really quite amazing how he can just shake and bake people right out of their shoes. And that's what happens with some of these stocks where they'll break out. So this is, again, a really nice VCP where you see you have 1, 2, 3, 4. It gets real tight in here, right? So now it comes out, and sometimes they'll come out strong. It doesn't have to be a little feeble breakout like this to have a Hardaway crossover. It could be a strong breakout. But what will happen is you get stopped. It'll come, and this is usually the stock will go below the low in the pivot, and a lot of people will put their stops. I put my stops a lot of times at the low of the pivot, and that's where you'll suck in a bunch of quick short-term traders and stop them out, and you'll get a shakeout below that pivot. But once everybody's knocked out, which only takes sometimes a day or two, the stock just turns around and just rips back higher. Very often what will happen is the stock will rip higher, which I call a slingshot. And slingshots are very hard to take advantage of because they get extended and you're buying an extended stock. So I kept watching these Hardaway crossovers. They would cross over, they would shake and bake me out. They'd come back with a slingshot, boom, into high ground. It's extended, and I would never be able to buy it. And then it just the stock's gone. And I was in the stock a couple days earlier, a week or two earlier, and now I'm knocked out of the damn thing and it's taken off. So I was trying to figure out, how do I get on board these without, getting an extended stock. One of the ways is sometimes what they'll do is they'll run up like this, and then they'll pull back for a couple of days and pull back to the breakout and give you a pullback buy, or and in some instances you'll get a reversal, and then you get we're talking about the reversal recovery. This is pretty much everything all at once, where you get the pullback buy, then it recovers, you get the reversal recovery, you get the Hardaway crossover. It's just everything's all happening all in chronological order here. So how I would play this is, so I buy here, I get knocked out here, it comes ripping back, great sign, right? Pulls back. Now right here, as it starts turning up and takes out that high right there, I'm getting back in. I'm coming back in, and sorry. Sorry. So another way to play this is where you might reduce here. All right, maybe you have a little bit bigger stop, and you have a staggered stop where maybe part of your stop is below this pivot, and you have another part of it at a mathematical number. So below the pivot is 4 or 5%, and maybe you have the other half at 7, 8, 9, 10%. Well, you only got stopped out on half. So now when it comes back, it sets this up. You have yourself, you add back. So that's the Hardaway crossover. I'm not going to get into this, too much. We're not going to show a bunch of examples. I just wanted to show you that, and you can.
Yeah, I would just add that when you get an undercut, and you can see that's an undercut of a couple of weeks, that you want that undercut, you want the stock to come back very quickly, because you want to see that there's demand there. If it stays under that whole base, or under that red line there for more than 2, 3, 4 days, then it's probably not an undercut, and you've probably got a downtrend or just a sideways choppy movement. But the best undercuts, they come down, they undercut just for intraday, and then it turns and it gets back up into that base, and then the next day it moves higher. So when you do get a shakeout, or I call it an undercut, you want it to happen fast, because you want to see that there's demand at that price to push it back up very quickly.
And that's a fantastic point and tip, and goes with all undercuts, all shakeouts. If you're shaking out the low of a base, you're shaking out the right side in a handle, or below the pivot. The whole idea is that last little move down, that last move that undercuts that low, is those last weak holders. Yeah. All right. I don't know if I said this before, but we're weak holders. When you are using a tight stop, you're a weak holder. An institution is a strong holder. They're adding. Stock comes down, they're adding to it. They're buying weakness. We're not buying weakness. We're getting out. We're protecting ourselves. So we're weak holders. We could be knocked out very easily. So that's why our timing has to be impeccable. See, this is the advantage over the institution. The institution can't time the way we can time the trades. We can get in there and say, okay, it's going, boom, get in. Oh, that didn't work, out. Oh, wait a minute, it's turning back up, back in again. The institution can't do that. They can't take and move 1 million shares like that. We can move our couple thousand shares, or 500 shares, or even 10, 20,000 shares, even a relatively large amount of stock you can move. But like I said, to an institution, that's nothing. So when you get that shakeout, the whole concept is that wrung the last bit of water out. That's how you know whether you got that last bit of water out, is it comes boom, ripping right back. And that's why you would buy it on a pullback as it starts turning back up. If it comes ripping back and you get the slingshot, that's telling you that was a shakeout. That was the last shakeout before this stock is ready to go. So again, this is definitely getting advanced now, and these are subtleties, a lot of subtleties.
But I really like shakeouts, because undercut shakeouts, because it just, as you said, it takes out the weak holders, and it just gives me confidence that this stock is probably going to, if it starts moving out and it moves out on good volume, it tells me that they're just really strong holders, and this thing might make a great move. So it doesn't happen all that, that often, right? Especially right before a move. Sometimes it happens lower in a base. Like on this situation, it might have actually. I've seen them where they come back down below 70, where that prior low is, undercut that, and then start turning and completing a base. But no matter where it happens, it's great if they go down fast and they come right back up very quickly. And
Yeah.
as you said, in strong hands is where that stock's at now.
Yep. Great point. So just want to show you here before we wrap up on this little section here. This was a stock, and this was way back when I was using Telescan 2000 back in the 90s. This was one that I bought that had it has, you can see a little pattern right here, a little cup with handle pattern. It comes out and it had a little squat, right? And then you had the reversal recovery. You had tennis ball action. Everything just played out perfect. This actually had, everything was a natural reaction. Look, a little natural reaction back in there. I'm going to show you how long you can have natural reactions and just hold up and hold up. And right here, I actually sold right over here, was on June 14th of 96. You can't see it here because I don't have it. I don't have a moving average in here, but that was actually a close below the 50-day moving average. This just held the 50-day moving average the entire time. And then finally, when it closed below it, that's where I sold it. So this, again, this goes all the way back. I've been doing this, and Dave's been doing it much longer than me, and his examples go back into the 80s. Mine go back to the late 80s, and yours probably go back into the early 80s. And then of course O'Neill was doing similar trading going back, and he goes all the way back to the 60s. And then we had Love wrote the book that inspired O'Neill, and William Giller. That's where the cup with handle came from William Giller's Saucer and Platform, and the quantitative work of doing factor analysis, factor modeling, that came from Love, super performance stocks. That's where O'Neill got it from. And then we all go back to, Jesse Livermore was doing this stuff by reading ticker tapes and using pivot points and what we're doing with a ticker sense, they call it, or ticker feel. So I just included. I always like to see this. It's just kind of cool. This is the actual ticket. You would get the confirmed tickets, and this was my position here. I bought 1,000 shares. It was AccuStaff 24 and 3/4. Of course, I think here it's adjusted for splits, right? Yeah. So this wasn't trading at $4. Just like I said before, all these stocks that you're seeing, some of them are showing they're like trading at 3 cents. They weren't trading at 3 cents then. They're adjusted for splits. But this is the real time ticket. This is the real ticket that matter of fact, I have from the 90s, I have stacks and stacks of these. I saved them all. So I have all these stacks of these tickets of all the trades. You can see right here, the commission was $29 total. That was deep discount commissions. Like, that's why I went to Pacific Brokerage. They were the only one. The next best commission at this particular time was Oldie Discount. Ernie Oldie started Oldie Discount, and he had $60 a trade. And then when that came out, we thought that was, wow, $60 a trade. We could trade now, and a friend of mine said, I just opened an account when I've been using it, and they're great. It's called Pacific Brokerage, and they're $25 a trade. So I switched over to there. Anyway, so we're going to wrap this up. Go ahead, Dave.
Yeah, go back to that chart. This is one thing you didn't point out. If you look right before the cheat, there was actually a shakeout. There was an undercut. Yeah, yes, there you go, right there. And it undercut not only that base, it went all the way back to the prior sort of looks like a cup and handle.
Yeah.
And went all, and see, then it one day down, and it started coming right back up, formed a new base, and then took off again.
Yeah.
I was also in this. I also bought this stock. I know it.
Yeah, this was I was actually around this. I think I was an O'Neill client at this time. I was an O'Neill client for a while back in the day. But I remember I couldn't afford his full service. Like, I didn't have the Nesme list and all that stuff. So I remember I had I don't know. Do you remember Patricia Jones? I don't know if you remember.
Yeah.
Patricia Jones was my sales rep, and she pitched me on the whole thing with all the the big data books and everything. And I said, I can't afford that. I'm a private trader, but I wanted to get the O'Neill work, and so I just got O'Neill's memos. but I would get like sort of some of the marketing. And I remember you guys showed that this was one of your big winners.
Hmm.
But now this stock here too, right here, you see, you got a real tight entry right here. This
Yeah.
actually set up a primary base, but I just had not seen it yet. This didn't get on my radar until over here, and then when I finally saw it, then I traded over here, but I never even had it on my radar over here. Okay, so I don't. Do you have anything to add, Dave, before we
No,
wrap up this section?
no, that's it.
Okay, so we're going to take a break, and then we're going to come back with a very important section, and that is how to identify a top and looking for specific sell rules. We've covered quite a bit, and we've got quite a bit to go. So take a break, and we'll come back, and we'll get back to with selling rules. We've been doing a lot on buying. Pretty much everything we've talked about has been buying, and now we're going to start talking about selling and nailing down profits and some sell rules for taking care of those stocks that actually work out on the upside. Okay, so we'll see in a little bit.